In the past week, economists got a shock as the dismal science suddenly felt like the natural sciences with a level of denialism from the Tea Party that science usually receives. But what the heck is the debt ceiling and why was it so bad? Well, first we have to understand the difference between debt and deficit. Debt is the overall amount of money the nation owes, which is around $16 trillion and rising. People think we owe it all to China, but actually 80% of it goes to American bondholders, and we store Social Security money in it. American debt is sold via treasury bonds, and after helping to rebuild Europe and defeating the Nazis, American bonds are considered the most stable of all places to put your money in investing. When times are good, you sell bonds and invest in companies. When times are bad, you put them all in T-bills or treasury bonds, as investments could bankrupt you. But the government will always repay its debts. During the recession, T-bills were being sold at negative interest, so they were paying us to hold on to their money. American debt is so stable and so important to world financial stability that around 2000, we were on our way to being debt-free by 2020, and the people were worried about the lack of stable money storage that might destabilize the world economy. Now on to the deficit. The deficit simply is the amount we spend as a nation versus the amount we bring in taxes each year. If we raise taxes, the deficit goes down. If we lower spending, the deficit goes down. If the economy improves and people are making more money, causing us to bring in more taxes, and less people are on welfare, the deficit goes down. The reverse is also true. If we tax less, spend more, or the economy tanks, the deficit goes up. Cutting spending seems easy in hard times, but many people depend on the government for jobs, and many businesses get customers near places where the government does business. Cutting spending quickly hurts jobs and people, so the government has to cut spending slowly so they don't ruin people's lives and the economy. It has to drop slowly to let the private job market absorb them. In fact, during every recession prior to this one, the government ended up spending more money creating more jobs to keep people employed during the economy and job market to recover. Reagan and Bush Sr. both created jobs during the recessions, ending them quickly, while we're firing government employees at a record rate in this recession. Reagan especially tripled the debt during his term, much of it to boost the arms race that bankrupted the Soviet Union. He also cut some taxes for the rich, which raised the deficits and debt. Spending more money in a down economy is called Keynesian Economics. During good times, the government is a deficit hawk and carefully cuts spending when it has higher taxes coming in, as much as it can to safely pay off its debt. During bad times, however, the deficit skyrockets, spending increases dramatically for public works, and getting people back to work to help the economy recover. During a recession, interest rates are super low and T-bills are in such high demand we basically don't have to pay interest on that debt. Recessions are perfect times to do big public works projects to get the people trained, working, and spending money, creating demand. We would do this, except there's another school of thought called the Austrian School of Economics, created by Hayek and furthered by Milton Friedman, two economists that rationalize and sell ideas to the world that government shouldn't act like an insurance company or a regulator or tax the rich, so that during a crisis they can expand their monopolies more by buying up bankrupt businesses and running roughshod over the environment and public health and buying politicians. They spread their ideas in two ways. One, by educating people on one half of how the free market capitalism works, which is absolutely true, but ignoring pretty much everything presented prior to this video. Because what they teach them is logical, true, and complex, people come away feeling like they know everything about economics. The other half involves framing the debt debate based on people's understanding of personal debt, which is nothing alike, which freaks them out because if they were the same, we'd be in deep trouble and the entire nation would be ending up on the streets by now. The U.S. debt and personal debt have very little in common, but using the familiar frame of reference, the GOP has been able to craft a lie about the debt and how it works. Our personal income doesn't go up when the economy gets better. We can't tax wealthy individuals, lowering our own personal deficit. Our word is not so good to everyone that in hard times they will pay us to hold on to their money. Our personal instant stoppage of money spending won't wreck the world economy. The government debt and your debt run on very different rules, so we need to stop equating one to the other. In an attempt to stop borrowing, the Congress passed a measure called the debt ceiling limit that arbitrarily prevents this country from going over that limit. Except during a recession, you shouldn't cut government spending, even though ours did. The poor and middle class spend most of their money creating demand, creating new jobs. The rich spend very little of their money, especially in bad times. A rich person could buy 100 cars and not use them, but thousands of middle-class people could buy thousands of cars and put them to full use, potentially producing more money from their use or starting businesses. We're dropping our deficit at the fastest rate in history during a recession, which is why it continues to drag on, unlike recessions in the past 50 years. The GOP is using Americans' ignorance about how the government debt works to prevent the debt ceiling from going forward. We have a deficit that can't drop any faster, and because of the way the nation pays the trillions of dollars in bills each year is automated, there's no way we can just pay part of our bills and not select others. If we default on our debt, our word will no longer be our bond, and therefore we'll have to pay higher interest rates. Banks use T-bills as collateral when they do daily trades with each other, depending on income for that day. If T-bills drop in value, they'll stop trading with each other, and even less to the rest of us, causing a grinding slowdown in lending, and new businesses won't start or upgrade. Stable lending is much more important to company productivity than tax breaks, and if credit freezes up and trust in T-bills drop, world markets will have stability issues, creating a crash and another depression. But the Tea Party denies any of this, probably because most of them believe the Heritage Foundation claim that a default won't be that bad, even though it will be unconstitutional, because they truly don't understand any of this. At the point that I wrote this, I had no idea whether the economy would survive this or not. However, as it is and the rules still stand, please share this with other people who don't understand government debt, or government debt could end up being more like personal debt, with sky-high interest rates plaguing future generations. Please like, subscribe, or comment below. Also, please check out my Wordpress blog, which contains material that was not included in this video, as well as preview scripts to future videos. Thank you.